Hello and welcome to today's webcast. It is my pleasure to turn today's meeting over to Vinay Nedkarni, Global Head of Business Development. Vinay, the floor is yours.
Thanks, Brittany. We're taping this on the morning of March 17th, where markets are hopefully going to turn green for St. Patrick's Day. I'm with my friend and colleague Aram Green, who is portfolio manager on the ClearBridge Select strategy, as well as a co-PM on the small and mid-cap growth strategies for ClearBridge. Aram, good morning. Good to talk to you. We certainly live in interesting times. So I'm just going to start with just almost a personal question for you. You started as a buy-side investor during the tech washout in 2000. You became a portfolio manager in 2007, right before the global financial crisis washout. And I've seen you just in the last week just kind of be able to process this in a different way than back then, and you came onto the Select strategy in March of 2008. So maybe what did you learn from those washouts that you're applying now? What's totally different about this, and what are you thinking about as far as the risks as this shock from coronavirus has played out?
Yes, so I think, good morning, Vinay. Nice to talk to you today and all the investors that are going to be listening to this. Certainly an interesting time that we're in, and while it has some similarities to what we've experienced in before, there's a lot that's different here, as most of the drawdowns that we've seen and slowdowns in economic activity have been a byproduct of some sort of overheating in the market, whether that was when I started in the industry in 2001 after the dot-com bubble burst, or 2008 when we had a housing and financial collapse. Those were definitely environments where there was a major overheating in one area of the economy or within our financial system. This is being brought out by a virus that's causing both a demand and supply shock, and some of the playbook remains the same, but some of it looks different. As a reminder, before we make any investment, we spend a disproportionate amount of time on the risks, and that's really a key part of the management and business evaluation or due diligence process for us. And we stress test all of our assumptions under various arduous scenarios to make sure that our companies will survive a downturn or exogenous shocks which come its way. And this has both offensive and defensive benefits. The defensive characteristics are much more obvious, that we're investing in a company that will be able to survive throughout a business cycle, and that there's a low probability of any sort of dilutive equity raise. But really few appreciate the offensive opportunities at time of stress. Companies with strong balance sheets and cash flow strength and forward-looking management teams will do what they need to do to protect in the crisis, as well as also invest in the future through new product innovations, retaining and molding future leadership, poaching strong talent from competitors, and winning mind share with customers. So this really positions our companies to not only ride out the wave of recovery, but take a lot of market share. And so that's sort of the playbook that we've used continuously, is investing in high-quality companies that have strong balance sheets and flexible operating structures. So that should be pretty consistent in any sort of shock that we're seeing. But what's different this time, again, going back to the fact this is really more spurred on by a health crisis, is that some of the companies that maybe would be more resilient in a typical overheating of the markets or specific industries, really because there's a retrenchment of normal lifestyle, are less insulated. So we're just seeing companies that, like in the healthcare space, several companies that maybe might have been more resilient are actually seeing much more strain on their business, or expected to see more strain in the deferral of, things like elective medical procedures, which will really reduce the need for supplies, medication, and other consumable equipment. So there's a lot to be reused from prior downturns, But in every situation is new, and we're taking in the information in real time and having live conversations with our management teams to make sure that the de-risking process we did at the onset before buying that investment is still very much intact.
So I think the other thing that I was just thinking about in preparation for this call is obviously, especially after yesterday, you just have a sea of red on your screen, and you have a list of portfolio companies that you own today and things that you could own. So when pretty much everything's getting thrown out and down so much, how much do you have to re-underwrite your new names or your existing names, and really what's your process to prioritize what to focus on a daily basis right now?
So the first thing that you have to focus on is where your current exposures are, and that's something that we monitor continuously. But again, we always reevaluate that when new risks emerge or the probability of those risks rising increase. So this is the playbook that we've used in prior shocks or prior risk elevating periods. We'll quickly go into the portfolio and sort of bucket or evaluate your portfolio on various kind of a bucketing approach. So quickly go in and take a look at your companies and say, do they fall into the low, medium, or high risk bucket given the new risks that are present today? So this is what we used in the energy collapse of 2015, with the election swinging from what we thought was going to be more of a Hillary election to Trump leading. What we used in 2008, 2009 during the financial collapse. So there's always just sort of this reevaluation quickly of the portfolio into those buckets from low, medium, and high risk. And then you want to focus sort of a triage-like mechanism. My dad was an Army doc, so it kind of goes back to my core DNA of going and looking at those companies that fall into the high-risk bucket and really making sure that you're comfortable as much as possible with the aggregate exposure in the portfolio. So how much of your portfolio is exposed to that high risk, and are you comfortable with that as a percentage of the portfolio? And then from there, quickly diving in on a stock-by-stock basis to reevaluate under these new risk parameters whether there is still a strong thesis and a reason to continue to maintain that investment in the portfolio. So on an individual security level, we're re-underwriting that investment case based on the new information. What are we focusing on with these companies? We're probing on issues affecting demand from a consumer or user-based perspective. How are these companies adopting to changing lifestyles and their employees working from home, or their customers or end users working from home, and other new realities that this risk brings to bear. We're focusing on supply issues for either physical goods or service providers or any sort of elements that need to either be brought to market or to be enacted in order for this company to deliver its supplies, its solutions or products. We're focused on the cost structure, analyzing what's variable, what sort of levers management can pull on to pull back on discretionary spend, yet continue to push forward with the long-term roadmap of their business. We have historically favored companies that have a much more flexible cost structure for this reason. We spent a lot of time on the balance sheet. What are the refinancing risks that are coming on the time horizon? Do they have revolvers that they can tap? What sort of covenants are there on their debt to making sure that the financing is in place not only today, but if things continue to deteriorate, are there calls on their capital lines? Spending time on the cash flow of the company. Are there working capital releases? Is there deferrable CapEx? Are they thinking offensively that maybe there's an opportunity to use their strong balance sheet to make acquisitions? What would they acquire? and under what parameters would they change their strategy. So, we're living in real time with a lot of new information coming at us, and we want to understand the game plan that our management teams are using. And then the last piece of that is the opportunities. So how can our companies go on the offense and win market share, continue to invest in products and solutions for the future? So we want to make sure that these companies aren't entirely retrenching, that they have sort of a clear strategy to retrench where they can, to fortify the operating structure and the balance sheet, but always be focusing long-term too. This is a long-term game, and downturns provide just as much opportunity.
So we didn't include it in the visual presentation, but you've often talked about one of the edges that you have is a structural edge, that so few people are paying attention to the fundamentals of a company now, and it's really about baskets. So I guess it's early days, right? It's still very, very early days. But are there some trends you're observing from your company conversations that aren't as obvious to maybe what's in the headlines right now?
Well, I think the first reaction is just to shoot companies that seem to be more in the bullseye of the virus and the impending crisis. And I think that, so that's one thing. And I think that if you dive down, a lot of those companies have very variable cost structures and strong balance sheets, and they're going to see a pretty sharp rebound. So we're definitely spending time on some of those companies that are the equity values have collapsed, 50, 60%. And we're spending, we think there's going to be some opportunities there. I think it's still pretty early we're touching about 4 to 6 companies a day right now. Those are portfolio holding companies. We're still doing some work on new ideas because we think there's going to be opportunities there, but most of our time is spent on the existing names that we own in the portfolio. And I'd say there's kind of few surprises, which is a good thing, that we're not being surprised much by what we're hearing from companies. So still early. We're hearing about rebounding activity in China and Asia coming back online, which is good for hopefully that if in the Western world we can kind of work our way through this in a couple months' time, that things can start to snap back. And I think the surprising element is or not entirely surprising, but the silver lining is that balance sheets seem to be in really good position. Interest rates are very low, and our companies have very available revolvers and other capital that they can tap into. So I think our companies are in pretty good shape on the balance sheet side.
Good. So obviously people who've invested in your strategies for the last 13 years are very familiar with your kind of pyramid structure, with your portfolio construction pyramid, with kind of disruptors, steady eddies, kind of evolving opportunities, and the alternatives bucket. So maybe just walk through, as you're thinking big picture, about those areas of the pyramid and the portfolio, and where you're spending more time.
So where we have been spending time looking for new opportunities and where we're seeing the majority, I think, of the opportunities that we're going to be deploying capital into is in 3 areas. One is still in technology and software. We remain still very positive on software, specifically enterprise software. Those companies are emblematic of the companies that we look to invest in. They fulfill a deep need with an innovative solution. They have high recurring revenue streams, greater than 90%. They typically drive 100 to 130% of their forward revenues coming from the existing customer base. So they don't have to sell a lot of new customers. It's more about going into their existing base of customers. And because their products are so easy to adapt and enterprise customers see a positive return on implementing them, they're continuously buying more, either adding seats or adding more modules and functionality. So it's a lot easier to go and sell an existing customer than try and get a new customer on the platform. So we've got some nice growth from the existing install base. Gross margins in the 70-80% range, and these are cash-rich balance sheets where some between kind of 5% to 20-25% of their market cap is in cash. So they are bomb-proofed on the balance sheet. And so these are durable growth businesses possessing some significant strategic value. And so that's an area that we have some sizable investments in, and we're going to be making more investments in that space. And some of these companies not only are in a good financial position, and we think can continue to kind of grow, albeit at a slower rate than we thought starting the year, but through a crisis we think they can continue to grow. Some companies are really positioned nicely to benefit. Companies like DocuSign, which was a company we made as an investment in as a private company, which went public around 2 years ago and is now a substantial holding in the portfolio. They enable remote transactions and business being conducted without the need to have physical documents. So business, it's a crucial element of conducting business sort of remotely. And so we think that adoption of DocuSign could increase. Another area that we're looking into is just general network congestion from remote working and applications being more broadly distributed. I'm sure people who are working at home are experiencing some technology glitches, either due to network or application overload. And so we've invested in a number of software companies that can ease that congestion and those bottlenecks. So software is still an area that we remain overweight and adding exposure to. Second area are companies newer to market. So these are companies that either most likely recently went public in sort of the last 6 to 9 months. These companies, because they're newer to market, they don't have the history and the relationship with public investors and are likely smaller positions in most people's portfolios. So as investors look to consolidate in companies that they have known for a very long time and they're looking at the bottom of their portfolio to kind of weed out, these are companies that are sort of the baby being thrown out with the bathwater. These companies have underperformed recently and are trading at really steep discounts to similar peers. And there's really no reason for them to trade at such large discounts other than they're not sort of proven entities in the public market. So we think that that's been a real area of opportunity, and we've been adding to those names. And the third, which is what I talked about before, is that there are companies that are in the heart of the crisis, and just because the company's business has been the bullseye of this crisis doesn't mean the stock isn't a good investment at these levels. So some of these businesses are a bit more cyclical, or they're in areas like ride sharing or travel, and they've really been punished where these stocks are down 60, 70%. If we believe that these companies will survive and they have highly variable cost structures supported by strong balance sheets, can maintain a leader position, if not build on those leadership positions, we expect revenue to snap back quickly, and we're looking at the equity valuation, which seems implies a much worse outcome than what we expect over the next few years. We have been pecking away at some of those. So overall, we continue to favor asset-light companies or companies that aren't heavy CapEx users, industries across most sectors that have well-defined roadmaps for long-term success. That's where we're deploying incremental capital. On the cyclical side, we feel like there's still generally too many unknowns for most situations, and these companies really are going to rely on GDP resumption, and we're still kind of several quarters out from there. Specifically relating to bank stocks, So I'm not exactly sure what we're looking for there to determine that it's safe to step in, but from a high level, those companies we're expecting improvement in net interest margins, which seem to be pushed out. And on the credit side, it's really unclear sort of the rules of engagement there. So continue to be underweight substantially bank stocks.
So I'm going to try to roll through three quick questions to kind of end the call today. One, you said this to me last night. I was surprised. There's a perception that, the large companies are more global. They're more, they have more diversified supply chains, but yet large caps have outperformed small by 1,000 basis points year to date. And your portfolio tends to have more of a Smid Bias, relative to other all-cap strategies. So is that just the worries about credit and just kind of small businesses, or is there anything else that you've observed of what's really driving that dynamic year to date?
Yeah, so as of last night, year to date, small is underperforming large by 1,000 basis points, and on the 1 year basis, it's around 1,600 basis points. So pretty sizable outperformance, large over small, and I think that's driven by mostly by fear. People feeling more comfortable owning larger cap blue chip companies, and so that's driving people to favor large over small, which I think is an opportunity for Select and investors who are wanting to put on exposure to the space. So I think that's the primary dynamic that's taking place there, and that's part of the reason why we're finding most of our better opportunities to deploy capital now in some of the smaller to mid-sized market cap companies.
The second one is, we talked about this yesterday. I think people know the strategy has within its alternatives bucket the ability to selectively be short individual names, and yet you haven't really done a lot of that. In fact, I don't think there are any in the portfolio today. So maybe just walk through just your thought process on that, and maybe now after a washout, you focus on the longs, but just kind of some of the dynamics that have been involved with shorting stocks during this volatile period.
Yeah, so as a reminder, around 10% or less of the portfolio can be invested in things other than being long common equity. So that includes shorting, private investments, options, and fixed income. And we've largely been nascent in fixed income for the last almost 4 or 5 years, just where interest rates are, and we've generally, when we've done fixed income, it's been more credit sensitive, distressed type of fixed income securities. So we've been looking at that now there's more stress. Credit spreads have widened out quite significantly, particularly in areas like energy. But overall credit spreads, while they've increased almost doubled, they're still way below where we were during the financial collapse. I think part of that's just the whole curve has flattened and declined, and so just interest rates generally are pretty low. As it relates to shorting, we covered most of our short positions in the fall. We had a number of short positions on, particularly within some of the tech companies, where we had known those companies as private investments. They had gone public. They hyped up businesses that we thought were mediocre companies. They had extremely high valuations on them, and so we saw an opportunity to short some of those companies. Post WeWork, a lot of those company stocks collapsed, and we covered those short positions. We kept on some of the shorts where we thought there were in more mundane businesses, slower growth businesses that were more exposed to GDP, and were also secularly and competitively challenged. We covered those shorts about a week ago or so, and with the VIX having increased to greater than 80 points, the cost of hedging is really prohibitively expensive. So it's not only the cost of hedging, but we also thought like the thesis had sort of played out in those companies. There was no fear built into them. They were secularly challenged. The secular challenge element played out, and now people are fearing that we're going to have a recession here. So that kind of, with those stocks being pressured, they were imputed in the valuation of those companies. So one of the ways in terms of us adding exposure is taking some to the equity markets on the positive side is taking off some of our negative exposure. So that was, instead of putting some additional cash to work, we covered our short positions. We've been looking at options. Options are very expensive too. You look across the portfolio on our option screens, and options pricing is in the 95th to 99th percentile. With the VIX being very high, the implied volatility is off the charts, levels we've never seen in some of our companies. And so we're thinking about how we could use options to maybe put on some exposure. Again, using options is extremely expensive, just like shorting. So I don't think there's a need to do that. And then on the private side, we are involved in a number of private investments. Private valuations tend to not be as volatile as public markets because you don't have the liquidity. So investors who are investing in the private market are not thinking about what the price is going to look like in a week or 2 weeks from now or even 3 months from now. They're thinking about what is this company going to look like in 3 years and 6 years and 10 years from now. And so we have seen some compression in valuation, specifically post-WeWork blowing up and SoftBank having pressures. So that's opened up the opportunity in dislocations in that market. We're in the late stages of evaluating and investing in one company that will hopefully, that financing will close the end of March, early April.
At the same time, you and I talked about this, right? Private companies don't have to mark to market. So this public company reset has probably put, that spread between private and public, that certainly compressed probably over the last few weeks. Maybe the last thing is I always say people get overconfident in their forecasting, and you're certainly not one who tries to make forecasts. But I'm going to ask you more. What are the things you're paying attention to going forward? What are you kind of watching for from here to give you either increased confidence or to say, hey, this is going to be something that's structurally damaging longer term?
So I think in terms of, we talked a lot about the company-specific side, and that's where we tend to focus 80 to 90% of our time is making sure we're picking and owning the right companies, not just for the environment that we're in now, but throughout the course of a business cycle, that we're investing behind forward-looking management teams that have certain levers they can pull on to sort of outmaneuver whatever gets thrown their way, and a balance sheet to support that growth. So that's the company-specific side. What are we looking at in the markets to understand sort of where we are and looking for some signs of stability and calmness? One is the VIX, so that volatility index. We had been at Valentine's Day trading around 13. That spiked up to 80 as of yesterday. That's a level that we didn't even see in 2008. We saw it intraday, but that's a new high close. So I think we need to see the VIX come in quite substantially from here in order for big asset allocation machines and CTA and other sort of non-fundamental investors come back into equities. We're watching credit spreads, which have ballooned out. They are much higher, as I said, in more distressed industries and sectors like energy, but still there is it's still at a relatively and historically low level. Earnings, so I'm really excited to get into earnings season for our companies. We're talking to them now, but they're about to go in their quiet period for the next 2 weeks, 3 weeks until they report earnings, and we're going to be in this kind of a little bit of information vacuum, I fear. So I'm really looking forward to come out the other side, kind of mid to late April, and have companies report. And that's generally a time where our strategies have done well, is when we hear from companies and they talk about the relative resilience of their businesses. we're looking at the virus metrics. This is a health crisis, and so we want to see the number of new patients and the mortality rate flatten out, which is what we've seen in parts of Asia. And so we're kind of in the thick of the storm right now in the Western world, in Europe and the United States, and so we have to get through that tough environment. The numbers are probably going to look worse before they get better. And then the last piece is government intervention. Our society is at war with the virus, and that's something I've never lived through. I don't think most people have lived through. Certainly our grandparents have experienced environments like that. They're still around. But our government needs to throw everything at this pandemic, and we can deal with the deficit and other repercussions down the road, but whether it be fiscal stimulus or other sort of packages, I think our government needs to get really creative to help support those that are in need, both on the healthcare side as well as hourly and part-time workers who were really counting on their job and their paycheck to just survive and support their family. So that's sort of the things that I'm watching for. On a sector level, we're continuously seeing just a flight to safety. So on a day like today where the market's up 2%, you've got utilities up 6%, staples up 5%. So it's really driven by safety buying. And then you look on the flip side, you have energy trading down 2%, consumer discretionary is down as well. And then, the other sectors, real estate, financials, are kind of flirting with break even. So even on days like today where the market's up, it's really driven by safety. It's not people putting risk on. So we need to see risk appetite come back.
Really great closing comments, Aaron. I'm going to close the call by just giving our standard disclosure so that please note the following, that past performance is no guarantee of future results. The opinions and views expressed in today's call are of the individual speakers as of March 17th, 2020, and are not intended to be a forecast of future events, a guarantee of future results, or investment advice. Any statistics referenced have been obtained from sources believed to be reliable, but the accuracy and completeness of this information cannot be guaranteed. Neither ClearBridge Investments nor its information providers are responsible for any damages or losses arising from any use of this information. So with that, the legal disclosure is out of the way. Thank you so much for listening. Godspeed to all of you. Have a great day.